This is Flip Video 2.1 Circular Flow and GDP. So this is our first set of notes and topics in Unit 2, Economic Indicators. So Unit 2 is all about our macroeconomic indicators that we will use to grade the U.S. economy, and when we get later on in the semester, start grading other economies as well. So we're going to start by talking about the circular flow model. And our circular flow model is just a simplified representation of the macroeconomy. So this picture over here is a simplified version of the model. And it shows our four main factors in the circular flow model, our four main players, we could say as well. Our first player in the circular flow model is households, and these are the individuals. So you and I would be considered part of households, where we supply factors of production in order to purchase goods and services. The markets for goods and services is also called the product market. So those are our stores. So Target, Walmart, the grocery store, the mall, any place that we can go and buy a good or a service. Our product markets have become online as well, so it doesn't have to be a physical store anymore. Amazon is a product market. Firms is the third player. Those are our businesses. So Amazon would also be a firm. Coca-Cola, Toyota, Apple, any of those big businesses would be considered a firm. And then our final player is the factor market. So the factor market is just where you go to work. This is where your job is. So if you work at Target, you go to the factor market, Target. Our circular flow model is a great way to show how the entire economy works on transactions. So if we look at this part of the loop here, we have two arrows moving, two parts of this loop. The first loop is payments. So you can see households pay money to product markets in return for goods and services. So here's that second loop, the goods and services loop. Everything's a transaction. Nothing is one-sided. There is always a payment exchanged for a good and service. So same thing with households in the factor market. So remember, factor markets, this is your job. You get paid to go to work. So here's that payment loop right here. And then in return, you provide factors of production. You provide labor to your job. We also have a more advanced or expanded version of the circular flow model, which adds the government into our macroeconomy here. So our previous model didn't have the government, so now here's an expanded one that does show the government. And we can see that the government is right smack in the middle of our circular flow model. So this expanded version of the circular flow model includes the government and how they interact with our resource market. So remember, your job. Individuals is the household, product market is the store, and then businesses, those are the firms. So we're seeing how the government is interacting with these four players as well. You can see that everyone is paying taxes. So businesses pay taxes to the government. Households pay taxes to the government. In return, the government can provide a subsidy to businesses. We talked about that in Unit 1. It's that government assistance to industries, and then transfer payments to households as well. This would be social security, unemployment, some type of welfare benefit as well would be considered a transfer payment. And then the government provides public goods to both households and businesses. So that'll be rules, infrastructure, regulations, all of that would be considered a public good. We can also see that the government participates in the stores and in the job market as well. So the government hires employees, and in return, those employees provide factors of production to the government. And the government also shops. They go to product markets to purchase products, and they, in return, give them the products. In an even more expanded version of the model, we would actually include the rest of the world, and we would add imports and exports to this model. So what exactly is gross domestic product? Well, it is the final value of all finished goods and services produced within an economy in 1 year. So the key words here are final value and finished goods and services. Those are the key words to gross domestic product. If it is not the final value and it is not a finished good or service, we do not count it in gross domestic product. So what exactly are we not going to count in gross domestic product? Because it has to be a final value and it has to be a finished good or service. So anything that's considered an intermediate good, we would not count in GDP. So that would be things that go into a product. So in the US, we make cars. We get to count the final value of the car, but we do not count the engine and the tires and the leather and the different technology pieces and the steel and the aluminum. We don't count any of that in the car. That's already been counted separately. So we do not get to double count anything, which is why we exclude the intermediate goods when we're counting GDP. We do not get to count anything that is an input. So again, anything that we look at as a resource cost. So we don't get to count electricity or water or oil in our gross domestic product. We do not get to count anything that is used. So if you drive a used car and you purchased it used, that purchase did not count in GDP. Next year when you go off to school, you might have to buy some textbooks, and you're going to want to buy the used textbook because it's cheaper. We won't be counting that in our gross domestic product. If you go to thrift stores, we don't count any of those purchases in GDP either because it's already been counted. We don't get to count it twice. We also do not get to count any financial asset purchases, like any stocks or bonds that you might buy. We don't get to count any of that in GDP. It's a total financial transaction. And we don't really have access to a stock purchase or a bond purchase. It just kind of sits there until we're actually ready to use it. And then we don't get to count any foreign produced goods or services. So any foreign made cars that we buy, we don't get to count in GDP. Any foreign products that we buy, we don't get to count that in gross domestic product either. So that leaves us with a pretty limited list of things that we can include in GDP. So anything that is domestically produced and is the final good or service, we do get to count in gross domestic product. Any capital good production, so any machinery or factory equipment, we get to count in gross domestic product. We get to count the construction of new structures. So if we're adding an addition onto a house, if we are replacing a building, we get to count all of that construction. And we also get to count any changes to inventories in gross domestic product. So how do we calculate GDP? How do we find out this wealth number that we rely on so much? Well, for our purposes, we're going to be using the expenditure approach to GDP. Another word for expenditure is spending. So this is also called the spending approach to GDP. And it is simplified as Sig X. So C plus IG plus G plus X minus M is our Sig X equation. This is an essential equation for the rest of the semester. So you do need to memorize this equation and understand what the components are and what would change them. So the C in Sig X stands for our consumer spending. So any good or service that a consumer purchases would be considered consumer spending. So all of your spending and my spending would be considered consumer spending. Investment spending is the purchase of inventory, so anything that is used to stock shelves. It's also the purchase of capital goods and machinery for business expansion, but it is not stocks or bonds. Let me make this very, very clear. Investment in economics is physical capital products. It is not investment in future stocks and bonds. It is investment in things we can physically touch. It is not a stock. It is not a bond. So investment and financial planning is stocks and bond purchases. We're not in financial planning. We are in economics. So investment is the purchase of physical capital products. The G stands for government spending, and that's anything the government spends our tax dollars on. And then the X minus M is net exports. And this is our imports minus our exports. So imports are foreign-made products, and our exports are domestically made products. So just a little bit more information on consumer spending and our components of SIG-X here. Consumer spending is all about the money that consumers spend in the economy. And there's two types of goods that consumers spend their money on. The first set of goods is durable goods, and these are going to be our slow-moving items. So this is going to be a lot of our appliances, expensive jewelry, cars, different like electronic items here, like robo vacuum cleaners, gaming consoles, really expensive cameras, or really cool toys. These are the things that are going to sit on the shelf in the store for a long time, and then they're going to be used for years and years and years and years and years. So think about like a refrigerator is pretty durable. It's going to last you a long time. If you're having to replace your refrigerator every week, that's probably an operator error issue. It should last for years. And then we can also purchase non-durable goods. These are the products that are fast moving, so they don't sit on the shelf very long. They're things that we use continuously and that we purchase all the time throughout the year. So, this is a great example of cleaning products. Those are a non-durable good right now. Any type of makeup or cosmetics would be considered fast moving. Food products are fast moving, so as medications are fast moving. Most of the time, clothes are considered fast moving, just because, you can wear out a pair of shoes pretty quickly. And gas is also considered a non-durable good. Investment spending, like I said, is physical capital products, things you can actually touch. So any type of machinery would be considered an investment purchase. Inventory space is investment purchases. Think about all of the Amazon stock stores that we have. The warehouse is full of boxes for Amazon. That's all inventory purchases. And then any type of real estate purchase would also be investment spending. You can touch all of these things. All of these things you can actually place your hand on and physically feel that purchase. You can't feel a financial purchase. And that's the difference. Investment is physical capital purchases, things you can actually touch, and it's not going to be your financial transactions. Government spending is what the government spends your tax dollars on. So any type of government program that is funded by our tax dollars would be considered government spending. Any type of infrastructure advancements would count. Our Smithsonian museums are also part of government spending. Obviously, our national defense would count as a government spending option. Social Security, Medicare, Medicaid, those programs would count as government spending as well. And finally, our net exports, which is exports minus our imports. So exports are the domestically made good and imports are the foreign made good. It does make sense that imports are being subtracted because they cost us money, whereas exports make the U.S. money. So the U.S. does actually make things. Baseball bats, we're very well known for baseball bats. Same thing with Boeing airplanes. They're very high level of export that we have. Imports is pretty much anything else that the U.S. can't make. So a lot of our cell phones actually are not made in the U.S. A lot of our clothing is not made in the U.S. If you check the tag on your clothes, probably see it's not made in the USA. Foreign cars, again, that would be considered an import as well. There is another way to count GDP. It's called the income approach. And this just takes our 4 factors of production, so our limited resources, and assigns them a payment. So capital products, since these are usually the more expensive items, they require a loan. So capital products earn interest. Entrepreneurs, our business owners, earn a profit. Land earns rent. And then labor, which is what most of us are going to provide to the economy, is going to earn a wage. So the income approach is IPWR, and it should, in theory, equal our spending approach because we shouldn't spend more than we make, but that's not always true. So we tend to kind of fall towards the expenditure approach a little bit more because this happens to be the bigger number than the income approach. So nominal GDP is the current year dollar value GDP. So if we say we have $22 trillion in GDP, then that's the nominal GDP. Real GDP is adjusted for inflation or the rise in our price levels, and this is considered a better measure of aggregate output because it's taking inflation out. So inflation is the rise in price levels. It can give us a false sense of growth if we see an increase in our GDP, but really that was just inflation that was increasing our GDP. So real GDP is the GDP we like to use when comparing for growth. Real GDP per capita is our real GDP over our population, and this gives us our standard of living average. This is a great way to put an individual dollar value on individual people. So it actually says each person in the U.S. is worth like $48,000, I think is the U.S. GDP per capita. So it gives us a much better picture of how productive a country is or an economy is when we use real GDP per capita. But there are limitations of GDP. First of all, it excludes all non-market transactions. So think about the black market. Anything that you buy illegally or participate in illegally is not included in GDP. So all of our drug sales aren't counted in GDP. Marijuana has been legalized in quite a few states. But since that's not a federal legalization, we don't get to count any of the profits from our marijuana sales. So that's a lot of money that we're losing that we can't count in our gross domestic product. Anything that happens in the black market also does not count in GDP. GDP also does not account for the degree of income inequality. So we do have that GDP per capita number, but it doesn't actually say each person is that productive. It just says that's what each person should produce in productivity, but it doesn't tell us how unequal our income distribution is. It doesn't tell us how many people live above the poverty line. It doesn't tell us how many people are millionaires or billionaires or live in the 1%. It also does not tell us if our growth rate is sustainable. So again, if we're just comparing our nominal gross domestic product numbers year after year, that includes inflation. And so we don't know if our growth is actually true growth, like we're actually making more products, or if inflation is just growing faster. And then it also does fail to account for the negative impacts to our limited resources. So our gross domestic product doesn't take into account resource destruction. It doesn't look at harmful emissions into the air. It doesn't look at waste that's produced when we're making products. So it doesn't account for negative impacts to our environment. So a quick review of circular flow and GDP. So our circular flow model is a simplified model of how goods and services and payments flow throughout a macroeconomy. Remember, there's two loops in our circular flow model, the loop of goods and services and the loop of payments. GDP is the final value of all finished goods and services. So two key words here, final value and finished goods and services. That's what's counted in gross domestic product. The expenditure approach, so SIG-X, is how we're going to focus on calculating gross domestic product. Real GDP is adjusted for inflation, and GDP has limitations.